following is an update and technical analysis on natural gas futures based upon the 240-minute interval in which I had mentioned on the 21st of February 2024 we were trading spot price 176 a unit, and where we had constructed three major reactionary highs upon the 240-minute intervals, and it would be ideal on a great risk-reward ratio short trade setup to the downside based upon the 786 Fibs retracement in correlation of the 179 price resistance, and it would be ideal great double-digit crash to the downside in a reflection in a retest of the monthly intervals 1611 price support and the additional 1 Fibs 159 price support down below, in confluence of a minor, call it a minor reactionary uptrend line to the upside. And here's the update. With the entirety of that trade on a honing in on to the downside, reflecting on the 1 Fibs retracement, the entirety of that move was good for an 11.5% crash double-digit move to the downside, where Friday we had headlines talk again about the charts manufacturing the headlines, driven by the latest Energy Information Administration report and predictions of milder, warmer weather, which led to reduced demand, where prior to this, the Energy Information Administration disclosed that although weekly stock levels decreased by 60 billion cubic feet to 2,470 billion cubic feet, yearly stockpiles increased by 265 billion cubic feet, surpassing the 5-year average of 2,019 billion cubic feet by 451 billion cubic feet. And that was the catalyst, fundamental catalyst for a huge sell-off to the downside. And here we are reflecting, which I would get honed in on and gearing up. I've added some new key targets if and when some of the short sellers and or bear traders are honing in on for a much larger double-digit crash to the downside. And I believe the line in the sand will be the 152.7 monthly price support level that was reflected upon and or bid by bulls the last time we had that interface, potential reaction, and that was the short squeeze rally to the upside. Short sellers, they want to see an additional 240-minute candle close, big breakdown on a re-challenging of the 1527 price support level. And what will be so significant upon taking that level out, in my opinion, will be the burn off of this positive divergent low. We had positive divergences constructed amongst all four key technical momentum indicators, and in my opinion, a solid 240-minute interval candle, big breakdown, sell signal down below that key inflection point could usher in potential stops and or margin calls to go off, re-challenging these positive divergences that are intact, that will only constrict and or challenge already in a bearish crossover state here in the moving average convergence to retest its zero line threshold. That could be the ultimate re-challenging of those positive and or bullish divergences that were constructed here, and that could be the catalyst for a much larger drop if and when these positive divergences are outright burned through. Long traders, bull traders, if and when 152.7 goes, they need to hold the divergent low here to sustain and hold off those positive divergences that were constructed if and when we get that bounce to the upside to re-challenge the 152.7 and 1611 price support level. That will be the ultimate line in the sand, in my opinion, down below on a key juncture to hold those positive divergences intact, to continue the potential and or bottoming out of the foundation of this momentum shift within the indicators to sustain a prolonged move to the upside. I've additionally added some new monthly interval price support levels based upon the 143 price support and additionally the 133. That will be more than likely, these will be the key pivot points if and when we go on to re-challenge and retest some of these key junctures to hold off and or backtest amongst that needs to be defended by technical long traders at all costs, in my opinion, where I believe the most valuable long trade setup will now transpire through the backtest of the 143 price support to keep the divergent low intact to sustain any sort of positive divergence. And upon taking you out to the monthly interval, this is the biggest key inflection point where I've added 3 new technical levels that will be respected by long traders and or bull traders, call them significant historical, multi-generational, honing in on major reactionary lows and highs based upon the early 90s. These will be key pivot points if and when we go on to retest and re-challenge this key inflection point. Where I had mentioned in that previous video, the neckline resided with the 194 price support level, and a ton of stops and or margin calls really went off there, dragging the commodity price to the downside, being blindfolded behind the shed there. And that was just a harsh sell-off to the downside with damaged momentum indicators here within the monthly interval. Make no mistake about it, I believe an OPEC-styled company protest could be in the cards. When you consider how harsh this sell-off was, you could increase the odds, which could increase the odds for a much larger comeback and a companies conspiring together to hold the price together.